All right, so for today's class, I also want to go through the other part of homework 4. So it was the ROIC tree analysis and the CFI analysis. What's going to be important on your exam and when you go through the ROIC tree for your group projects is that you refer to specific numbers as part of your solution. So if you do not put numbers in, you're going to lose a lot of credit in your answer because we don't know what you're referring to. And somebody in my previous section said, well, isn't that tedious? And I said, unfortunately, that's a lot of what we do in finance is very tedious things. And so we're going to have to talk about sort of the before and after numbers. So for example, if I were looking at this company, I would say that in 2009, their after-tax ROIC was 63.4%, and 5 years later, it fell to negative 12.8%, a negative 120% decline, right? 3 factors that affect it, the first being tax rate. Their tax rate went from 32.4 to 45.8, which should have theoretically hurt them. But what really hurt them was their pre-tax ROIC went from 93.8 to negative 24.9, negative 126% decline. So the reason that their pre-tax ROIC went down, 2 reasons potentially. One is margin, 2 is productivity. Their profit margin, operating margin, went from 24.6 to negative 8.1. So that's their real problem. They went from very profitable to actually losing 8 cents per unit of sales, drop of 133%. And their productivity worsened from 26.2 to 32.7, right? But the real problem this company's having is the decline in the operating margin. Now, what's interesting is that tax rate in 2013 of 48% actually helped them because when they lost money, it became a tax credit, okay? But nonetheless, this company's real problems is lack of profitability. Second level of analysis, what really hurt their margins? Their gross margin went down, but it only went from 49 to 48.3, only a 1.4% decline in their gross margin. What really hurt them was the big increase in SG&A. It went from 21.5 to 39.1. An 82% increase in SG&A spending. And their spending on depreciation went from 3 cents to 17 cents, a 485% increase in depreciation. Those are the 2 factors that really hurt their operating margin. Now, on the productivity side, the reason why their productivity worsened wasn't working capital. Working capital went from 12.9 to 11. That actually helped their productivity. For them, it was all about PP&E. PP&E to sales went from 12.1 to 21.6, a big decline in PP&E productivity, right? And acquisitions, intangibles went from 1.2 to basically 0, so that kind of helped them a little bit. So working capital and intangibles helped a little. Their real decline in productivity was PP&E. So primarily what hurt this company was a big increase in SG&A and depreciation and a lot worse utilization of facilities in PP&E. That's what you really would need to say to get full credit. This third part of the analysis, the days associated with working capital are not really required for your analysis. It's more general information. You're welcome to talk about it, but I'm not going to ask you to talk about it on the exams. So, by the way, this company, does anybody know who it is? This is BlackBerry. So if you want to know why BlackBerry, formerly Research in Motion of Canada, has been in so much trouble, these are their numbers. And you can clearly see, and this is something you should do on your final projects, is not just talk about the end points, you should talk about what happened in between, but you can clearly see it was between 2011 and 2012 that BlackBerry started to experience its collapse. And it's really the last 2 years that it's gotten really, really bad. And obviously, most of it was their spending on SG&A. That's their spending to basically acquire subscribers. And what they're doing is they're spending a lot of money to keep their people, but people are abandoning them. So it's not like they're losing money on their phones. They're just not selling many phones. They're spending lots of money to do it. In fact, that's the same thing for depreciation. Depreciation is like a fixed cost. And when you have a very few amount of dollars on that big fixed cost, your cost per unit spikes. Now, that's not something I wouldn't expect you to say on the analysis. I'm just giving you additional information and context because this is BlackBerry. Right? By the way, the CFI is also on BlackBerry. Okay? So, again, for the CFI analysis, Very important, you cover all 4 sections. Operating, which is free cash flow, non-operating cash flows, what's happening to the debt cash flows, what's happening to the equity cash flows, and again, referring to specific numbers along the way. So, over the last 5 years, this company generated $14 billion of gross cash flow. They reinvested $7.7 billion of gross investment, most of that in capital expenditures, leaving free cash flow before acquisitions of $6.4 billion. They actually got about $114 million by disposing of assets, leading to about $6.5 billion of free cash flow, or a theoretical 46% payout rate, which meant they're reinvesting about 54 cents of every dollar back into the business, right, over the last 5 years. Now, again, if I refer to a couple of intermediate years, the big decline in their cash flow started to occur in 2011 when gross cash flow peaked at $4.3 billion, and the next 2 years it fell to $1.4 billion, also getting an operating loss at NOPAT being negative $463 million. On a non-operating basis, to get from $6.4 billion of free cash flow to $2.7 billion of CFI, they had approximately $3.7 billion tied up in non-operating cash flows. The biggest one is they had a big increase in non-operating assets. So again, we don't know what they are, but obviously that chewed up $2.3 billion worth of cash. They also had about $465 million of non-operating losses, and they increased their cash balance by almost $1 billion, $948 million, most of that occurring in 2013. So that meant they had $2.7 billion to pay out. BlackBerry pretty much doesn't have any debt, so there's no debt or interest really to speak of. So for BlackBerry's case, it was all about buying back $3.2 billion worth of stock, net of issues of about repurchase of, what was that, 300 or 133 million. So here's the thing, most of that stock buyback was in 2010, 2011, and then it basically slowed down thereafter. So really that's what you would have needed to say in an ideal world. Again, if you focused on the total, that would have been fine for the homework, but over time you should also start highlighting some of the key trends over time. And again, what we can see here is what really happened to BlackBerry, is that BlackBerry in 2010, 2011 was buying back a lot of stock, right? But that started to stop in 2012 as BlackBerry went into what I would say is a cash preservation mode. Because when they saw their operating performance deteriorate, rather than buying stock, they started hoarding cash. And that's really what they've been doing the last 2 years, because they knew tough times were ahead and they wanted to have flexibility for the tough times. And if they paid all the cash back, they weren't certain, my guess, that they were going to get the cash back. At least the banks may not lend it to them, and if they did, it might have been at a very high rate because of their deteriorating financial position. And so you could clearly see how they went into cash preservation mode because they cut their share repurchase and they started to slow their investment. Gross investment started to come down, and they started to increase their excess cash balance. And that's what we can kind of see in the history of BlackBerry. A little bit of context there. All right, questions about either of the two? As I said, on your midterm exam, you're going to have 2 more of these. Will be a different company that you will have to write up in a similar fashion. I'd say a few paragraphs for each one should be sufficient. And how much you write up is really just how verbose you are. Right? As long as you cover the important numbers, that's really what's going to matter in your write-up. You can be very concise. Yes? Ideally, you want to talk about all 4 sections, the total, and a couple of the trends over the 5 years. That's what would be ideal. Right? Because again, in BlackBerry's case, it's not like every year was the same. You could clearly see the performance improving through 2011, peaking, and then the rapid deterioration in 2012, 2013. So that trend would be important for us to understand when we started to really analyze the company. Okay. Other questions? All right, the rest of our class today, we're going to talk about lecture note 7, which is multiples. So multiples will be covered on the midterm exam. And what's important to understand about multiples is an alternative form of valuation to cash flow valuation. But here's the key point. Multiples have to give you the same answer as a cash flow valuation. All right, because just because we change our methodology, and we talked about this before, we still have to get the same answer even though we're using a slightly different methodology. So what's really different about multiples valuation is in the DCF valuations we're going to do this semester, we're predicting the cash flows, and that will get us a predicted stock price. With multiples, we start with an actual stock price, and we kind of work backward to infer what the cash flows had to be. Right? Because the whole idea of a multiple analysis is we're looking at the prices of similar assets to basically try and figure out any difference in price between those assets and what could cause those difference in price. So what's very important in any multiple analysis is to look for similar assets. Now, in your personal lives, when you graduate, if you buy a house, a condominium, an apartment, basically you'll run into multiple analysis. Because as part of that transaction to buy or sell a house, you're going to have an appraisal done in that house. And the appraisal uses a multiples process. So this is what the appraiser will do. They'll basically say, okay, let's look for similar houses near the one that you're buying or selling that have sold in the last 6 months. And they'll look at every price that every house is sold for, and they'll look at the square footage of each one of those houses, and they'll divide to get a price per square foot, right? Then they'll average it. They'll get an average price per square foot for your area in the last 6 months. They'll then look at your house, they'll look at your square footage, they'll multiply by the average price per square foot, and that'll be the starting appraisal price of your house, right? Except the appraiser will then adjust that up or down based on other factors. What factors do you think the appraisers might use to adjust up or down their value in the house? I get the average price per square foot, but what makes you worth more or less than the average? What factors might affect it? Yeah.
The age of the house.
So the age of the house. That would be one factor. And the condition associated with the age. What else? Yeah, if you have a pool, if you have a fenced-in backyard, you have a deck, that could affect the house as well. What else? Yeah. Yeah, your location. You know, what kind of neighborhood, what kind of school districts do you have? Where is the neighborhood? And where in the neighborhood are you? Are you on a cul-de-sac? Are you on a busy intersection? You know, are you on a lake? That location can have a big impact on the value of the house. What else? Yep. The lot size and the land. Yeah, are you on a big acre of land or, you know, real tiny plot? So that will obviously affect the value of the house. Yep.
General makeup of the house, like how many bathrooms are there?
Yeah, I have a friend that's looking for a house now, and he's looking at a 4-bedroom house that's 1.5 baths. And that's just a non-starter. He's got kids. So we'll not buy the house because it just doesn't have enough bathrooms. So obviously that could affect the value of a house. Other things, you know, what's the condition inside? Like granite countertops, cherry cabinets, what kind of carpeting, hardwood floors. Some of those factors can have some influence in the value of the house as well, right? But here's the point. Same thing applies to a company. So what we're going to do is we're going to do something like a price to earnings multiple or an enterprise value to EBITDA multiple of a company or enterprise value to sales multiple like we talked about with Facebook buying WhatsApp last week. And then we're going to adjust the multiple up or down based on factors, kind of like an appraiser would do on the house. The difference is in the corporate side, there's 6 factors that matter. 1, expected ROIC. 2, expected growth rate. 3, cost of capital. 4, tax rate. 5, capital structure. 6, non-operating items. Those are the 6 things that we will adjust the multiples up or down on as we compare companies, because those are the 6 things that will drive the multiples of the companies. But the same process basically applies. The nice thing about multiples is we can also use this to value private companies, because if we know the price of similarly traded public companies, we can assign a value to a private company in the same way, right? That's how companies like, for example, Facebook, for years, people could buy and sell on whatever that website was. Was the site that you could buy or sell Facebook shares on before they went public? It's like Second something. But in any event, people could assign a value to a private company because they'd look at the multiples that were paid for public companies to infer what they would be trading for if they were public. You could also use this for acquisitions, all right, which is something which we'll talk about in a few minutes called precedent transactions. The key to multiples, as I said, finding a similar range of companies, finding similarities. And as simple as that sounds, outside of an academic classroom, it's extremely difficult in the real world. And I'll give you a quick example. Disney. Who are the peers of Disney that we'd want to put in a comparison list? Who are their peers? So what we really want is people to do the same thing. So who does the same thing as Disney? Yeah.
They have a lot of different businesses, which I guess what makes it hard. But I guess you could say different TV stations. So guys compare to ABC, NBC.
Well, so there's a good point. Disney's got all these networks, but Disney's in multiple businesses. So I could compare them with a CBS or here's the problem with NBC. NBC is owned by Comcast. So the problem is finding just that part of the business to do the exact same thing. I'm part of a conglomerate that does many things. Or let's say I compare them with Universal Studios. Well, Universal is owned by Comcast. So it's Comcast Universal. So I also am throwing in all the studios of Comcast. I'm throwing in their ISP network, their cable broadcast companies. All of that is a hard comparison to make with Disney. Disney also has a cruise line. So again, I'm comparing that with Carnival or Royal Caribbean, but the problem is Carnival and Royal Caribbean don't do all the other stuff that Disney does. So as I said, as simple as it sounds to find peers, it's actually a very difficult process to actually find peers because so many companies do not exactly the same thing. So what do we do? Well, what we really want to do is we want to find companies that are at a similar stage in their life cycle that have similar growth and ROIC prospects. So if we can't find people that do identical things, find people that at least have relatively similar growth, relatively similar ROIC. That's actually one of the problems I have with the WhatsApp valuation that was done, is people are valuing WhatsApp, a company that's barely generating revenue, with big established companies to some degree like Facebook, which have been around for almost a decade and are generating billions of dollars of actual cash flows and profits. So we are comparing a little bit of an apple and an orange because they really are at a different life cycle. So I don't want to compare a startup to a mature established companies. And that's why, to some degree, I think the investor community starts to conflate the two sometimes, and it gets to be a real challenge with multiples. But ideally, we want companies that have similar growth rates, similar ROIC, similar capital structures, sort of similar stage of their life cycle. So how do we do a multiples analysis? Well, first, you got to select the companies to put in the group. And as I said, it sounds simple, but that's one of the challenges we're going to struggle with later in the semester. Second, we got to get the data to do the multiples. In this class, since we're doing valuation, valuation is based on expected cash flows. Therefore, historical data, historical multiples don't help us. The multiples we're going to care about are the multiples based on expected earnings, expected sales. So we're going to go to a database like CapIQ or Bloomberg to get this data. That's why we need a service like Bloomberg, because we have to get the expected numbers to get the expected multiples. Third, we're going to then calculate the multiples, and then we're going to try and understand the differences. So we'll get kind of like an industry multiple, and then want to understand why is our company trading above at what's called a premium or below the industry multiple. And how did those 6 factors that I previously described explain the differences in the multiples? And we're kind of working backwards to do this. We'll also get the idea of a range. So it's not just what's the average, but what is the range that people are willing to pay for each of the multiples, because that kind of gives us bands of value that the market would actually be willing to pay. So a couple of best practices to summarize. 1, find companies with similar growth and ROIC prospects. 2, use forward earnings, forward estimates when you calculate multiples, not historical data. 3, enterprise value multiples are preferable to PE ratios. Even though the PE ratio is the most commonly used ratio in the world today, and it's the most easily and simple to understand, the price per share divided by the earnings per share, it's actually the most difficult multiple to explain. And the reason why is earnings per share is based on net income, and everything on the income statement affects net income. which means everything on the income statement affects PE. So all 6 of those factors that I talked about affect PE. So PE is a 6-factor analysis. It's about the ROIC, the growth, the cost of capital, the capital structure, the tax rate, and the non-operating items. All of those affect PE. And so here's what we do in multiple analysis. We assume that if we chose a good peer group, cost of capital is the same or similar for all the peers, so it's not a differentiating factor. We assume that since you're in the same industry, you pay similar tax rates. We assume that since you're in the same industry, you have similar capital structures. We assume that you have similar non-operating items, if at all. So if we assume those 4 variables away, growth and ROIC explain multiples, right? But that doesn't always work out. So for example, in my master's class, which just presented their final projects today, which is something you'll be doing in about a month and a half, basically they were doing the healthcare industry. And they were having to explain, which you will have to do, the multiples for the healthcare peers. And one of the multiples they couldn't explain, and so what they actually did is they went into Bloomberg and they saw that this company had a huge amount of excess cash, and the other peers did not. And it was distorting their multiple because excess cash is part of their value, and nobody else had a lot of excess cash, and it was actually making their multiple much higher than it otherwise would have been, and it was, again, distorting what the multiple would have been. So that's why I said the problem with multiples is they're easy to talk about, and they're easy to understand in concept, but they can actually be very difficult to explain because so many things can impact one number, right? And so that's what we're going to end up doing is we're going to make assumptions that a lot of these factors don't impact multiples, but they often do. And that's why it gets actually kind of hard to do multiple analysis. So it's easy, but it's hard. How's that for an oxymoron? So multiples, where did they come from? If you remember, a few weeks ago in class, we developed the key value driver formula. And we did a little simulation where we had this company A and company B, and we plugged in their numbers and essentially created the concept of a multiple. Well, this slide in the PowerPoint represents the output by changing some of the numbers in that key value driver multiple. So if we had used that Excel spreadsheet. So using the key value drivers, if profit was 100, NOPAT was 100, cost of capital was 10%, at these levels of ROIC and these level of growth, this would be the answer that that model would give us, right? So as we get started, this column, the 10% column, says 1,000 all the way down. Why as growth increases, does the value of this column not change? The 10% column. Yeah. Yeah, the return is the same as the cost of capital. We got a zero spread, so there's not going to be any difference in value as the growth goes up. What about these two columns, the 6 and 8%? Why do these numbers get lower as growth increases? Yeah.
They're getting a smaller return on the amount that they're costing. So.
Yeah, they're getting less of a return on investment, and specifically they have a negative spread. When you grow a negative spread, you destroy value. That's what you see there. And so what's happening over here in the bottom right corner of this table? This is growth at a positive spread. It's almost exponential increase in value. All right? So here's how multiples work. We calculate the cash value of the firm. This is the market price of the firms. On the next slide, this is the same table across the top. $100 of after-tax operating profit at a 35% tax rate works out to $154 of pre-tax profit. 100 divided by 1 minus the tax rate. So basically, this is an enterprise value to EBIT multiple. We take this value, divide by 154, that's the multiple. So the company with the zero spread, in this case, at this cost of capital, would basically be worth 6.5 times next year's EBITDA. That's the way to interpret the enterprise value to EBITDA multiple. I'm willing to pay 6.5 times next year's EBITDA for this company, right? Now, why would I pay a lower than 6.5 multiple? Why would I pay a multiple of 5 or 5.4? So I got two companies. One's trading at 6.5 times earnings. The other's trading at 5.4 times earnings. Why is my 5.4 trading at a discount? Yeah. That's right. It has a negative spread. All right. So that's the point. I get the data in the market that this company's trading at a discount. I try and figure it out. And what it's really telling me, if I look at this table, is they're probably having a lower spread. All right. Now, here's where it gets a little tricky. What if my peer is trading at 7 times? Instead of 6.5, they're trading at 7. Can you tell me what growth return combination gets me to a multiple of 7? So where do I see 7 on this table? Well, 1, I see it at 12 and 3. Where else do I see a 7? 14 and 2. Where else could I see a 7? 16 and 1 point something. So here's the other thing about multiples. Multiples give me a sense of potential ranges of ROIC and growth, but they don't tell me exactly which one the market is using. So that's the other thing, is I can infer backwards sort of a range of growth at ROIC, but I can't tell you exactly what one they use. All right, but at least I can get some directionality. Company with 7 is probably a positive spread company that's growing. Company that's trading at a low multiple is probably a negative spread company that's also growing. And I can essentially start to figure that out. But exactly where they are in the growth return combination, I may not know with 100% certainty. All right, but I want to at least infer what the possibilities are by working backwards. The other thing I had mentioned multiples are used for is what I call precedent transactions. So I want to do an acquisition. What I'll do is I'll look at data on what people paid for historical acquisitions. And there are databases. We have 2 at the Smith School. One is a database called SDC Platinum, which is actually very hard to get into. But basically, SDC Platinum will give you data on just about any company that's been taken over. It'll tell you what they were trading at before, what was after, who the advisors were, what was paid. It's a very valuable database. It is so valuable and expensive that we only have 1 license. So during the day, only 1 user in the entire university can use this database. And it's usually a PhD student or faculty. So good luck trying to get in. But after 5 o'clock, it's unlimited users. So at night, anybody can get into it. But during the day, they restrict it. Now, CapIQ is also a good data source because Standard & Poor's owns both. And they're now starting to merge the data behind the scenes. So CapIQ is also another good data source for getting historical data on previous acquisitions. So again, if I'm doing an acquisition, I might go through a data source like CapIQ, look at what people have paid, and that sets a precedent for what I would pay. Right? Second is that I'm actually going through this right now. So I mentioned to you guys before that I'm a part owner in a company called Redhead Companies in Baltimore, Maryland. It's a marketing communication firm that we bought last year. And right now we want to issue some stock options to some employees. Well, the IRS says that as a private company, you can't issue stock options unless they're issued at fair market value. Well, how do I know what the fair market value is for my private company? Well, what I actually have to do is pay, sucks, to do what's called a 409A valuation, which is basically a valuation that's going to be given to the IRS by somebody that's a certified finance person. And as a matter of fact, my TA from 2 semesters ago, her name is Lisa Murakami, works for a company that does this, Evergreen, in the Maryland area. And that's a lot of what she does, is these 409A valuations. So we're having to pay, and these things cost between $2,000 and $5,000, that basically that they're going to come in and they're going to quickly, for a small business, tell you what you're worth. So here's how they're going to do it. I actually talked to the guy that's doing ours. He says, all right, so I looked up in CapIQ, this is the guy talking to me, basically small marketing and advertising firms in the Baltimore area. And based on the ones that were either publicly traded or sold, they're historically been worth 4 to 5 times EBITDA. And so he's going to use 4.5, the exact midpoint of the range, to value our company. So he's basically having us project 2014 EBITDA. He's going to multiply that by 4.5, and that's going to be the value of our firm. And then you're going to subtract all the debt that we have, and that's going to get us an equity value divided by shares. That's the strike price for our stock options. And then the other thing they do is they put in an illiquidity discount, which says because we're a private company that's not liquid, then they're going to knock 40% off the value because it's not easily traded. And that's a number that they've used in the past with the IRS based on what they've seen other private companies having to raise money. But I'm just telling you, it's a precedent transaction. It's based exactly on multiples. And so this is what you will do if you become a finance professional. because you'll do both the cash flow valuation and you'll do the multiple valuation. Yeah.
Is that the same type of thing that companies use for crowdfunding when they issue stock options on like a crowdfunding site?
If you do any stock options, it has to be issued at a fair market value. Otherwise, the government treats it as income to the person that gets it. So yeah, and again, I'm not too familiar with the crowdsourcing stuff, but I'm just saying if you're issuing options, you have to give a fair market value. Now, the advantage to many startups is when you start a company up, the value is worthless. So usually when you want to issue the options is literally right at the startup, because you can basically say you don't need a valuation to say my startup is worthless. But once the company actually starts to have assets, it has injections of cash, it has developed products, it has sales, then you're not worthless anymore. And that's when you actually have to do these valuations, right? But nonetheless, they use a multiples approach. That's what the example I wanted to give you. So, challenge with these transactions is that you do have limited information availability on precedents because not all acquisitions are disclosed, and that becomes an issue. They are based on historical prices, and the world changes, and people's point of view on what they pay changes, and that's one of the dangers with multiples, is that right now, social networking is hot, and therefore multiples for social networking firms are very high. But when the social networking fad passes and investors move on, then suddenly they're not going to pay the same multiples anymore. So we have to understand that there's a timing element to multiples. And finding true comparables, even with precedents, is a problem. And the other thing that's also true about precedent transaction is synergies. So for example, if I'm a big company with lots of distribution and I buy you, then you're more valuable to me than if I'm just a private equity firm and I take you over. So I'm not going to get the same synergies as the private equity firm. So that actually means different multiples, even in an acquisition. All right, this semester, I'm going to hold you accountable for 6 multiples. These are the 6 multiples on this slide that you're going to have to understand and explain. They are as follows. PE, which stands for price to earnings multiple, which is the price per share divided by the earnings per share. All right? And so what the PE tells you is how much am I willing to pay for a unit of earnings per share? Higher being more valuable. Okay? Now, again, what drives a higher multiple? Well, let's go back to our key value drivers equation. It was higher, assuming the risks are the same, higher growth and return. All right? So again, a higher multiple, higher PE generally means higher growth and return. Second, the PEG ratio, also known as the price to earnings growth ratio. So the PEG ratio is just that. You take the PE of the company, price to earnings ratio, and you divide by the expected growth of the company. Except in the PEG ratio, the earnings growth rate, the expected growth, is what's known as the long-term growth rate in earnings, LTG, and specifically the convention is the 5-year expected growth in earnings per share. So if I take the PE divided by the 5-year expected growth in earnings per share, that's called the PEG ratio. Now, in theory, what the PEG ratio tells me is where the PE says, how much am I willing to pay for a unit of earnings? The PEG ratio tells me, how much am I willing to pay for a unit of earnings growth? So the PEG is all about what I pay for growth. Now, again, if I go back earlier in the semester, I showed you this slide, and I said this was a very important slide. I said, as boring as it looks, this is an important slide. The reason why this was an important slide is this showed us 2 companies that had the same earnings, but we said one company was worth more because it generated more free cash flow. And the reason it generated more free cash flow is because at the same growth rate, it had a higher expected ROIC. So if you think about the PEG ratio tells me how much am I willing to pay for a unit of growth? What makes a unit of growth more valuable? Higher expected ROIC, because that means higher cash flow for the same growth. So in theory, the PEG ratio is the cleanest ratio at explaining expected ROIC. Now, the reason I keep using the word in theory is because accounting gets in the way. Companies make adjustments to their earnings all the time. Companies make adjustments to their equity all the time. And that will distort the earnings per share growth rate. So the problem with PEG is that in theory, it's the cleanest ratio for explaining ROIC, assuming that I don't have dirty earnings. If my earnings have been affected by one-time charges, gains and losses, then it can distort my PEG ratio. And that's one of the challenges with PEG, is that sometimes you'll do an analysis and the ratios won't make sense. And part of it is because the accountants distort the financials because they start making all these adjustments to the financial statements. And so every now and then, the ratios just do not make any sense. So that's something we have to watch out for. Ratios number 3, 4, and 5. These are the enterprise value ratios. The professionals prefer the enterprise value ratios over the PE ratios. The reason why is that PE is based on net income, and net income is based on the entire income statement. The enterprise value ratios are not based on the entire income statement. They're based on the operating profits of the business, and therefore they are less impacted, though still impacted, but less impacted by things below operating income. So less impacted by tax rate, less impacted by capital structure, less impacted by one-time gains and losses. So that's why people like the enterprise value ratios. So let's talk about the first one, EV to sales. What am I willing to pay, enterprise value, for a unit of sales? Right? So basically, when I sell something, how much value am I going to add to my company? Typically, EV to sales is most influenced by profitability. When I have higher profitability, then the bias is that I'll generate more cash flow and I'll be worth more. So EV to sales is very heavily influenced by the profit margins of a company. The second enterprise value ratio is EV to EBITDA. EV to EBITDA is how much do I pay for a unit of EBITDA. EBITDA is the cash profitability of the company from operations. So it basically says for the cash profitability, how much am I willing to pay? Now here's the thing, given the choice, I'd rather use EV to EBITDA over EV to sales because eventually free cash flow is what I'm trying to get to. And EV to EBITDA is a better predictor of free cash flow than EV to sales. So that would be a more preferred ratio. However, what do I do when I have a company like WhatsApp that doesn't have any EBITDA? Then I have to use enterprise value to sales, right? So generally, it's the earlier stage companies that are going to be more valued by EV to sales. When the companies mature and have defined business models when they're profitable, that's when we tend to transition to EV to EBITDA. Now, since free cash flow matters, the next ratio down is EV to EBIT. EBIT, aka operating income, is EBITDA after the DA, okay, after depreciation. So EV to EBIT mixes in depreciation. But here's the thing. If we treated depreciation as a cash expense, and I know it's not, but if we did, then what we get is a closer approximation for free cash flow. We get the cash profit of the business minus the cash reinvestment to sustain the business, the depreciation, and we kind of get the cash flow on the existing operations. So EV to EBIT is used more as a proxy for free cash flow of the business, assuming it's not growing. Now, here's the major difference between EV to EBITDA and EV to EBIT. If your free cash flows are consistent, meaning each and every year you invest a similar amount of capital, then EV to EBIT is going to be preferred. If your cash flows are lumpy, which is I'm a chemical company and I build a chemical plant once every 10 years, then EV to EBITDA will be more preferable. Because each and every year I'm not really spending that depreciation. I spend it in clumps. So generally for those types of firms, EV to EBITDA is more used to value. What will happen is those three ratios, PE, EV to EBITDA, and EV to EBIT, for more established firms, bigger companies that you're going to be dealing with this semester, are the three ratios that are used to value those industries. Every industry, the analysts tend to gravitate on one of those ratios. So you'll realize that when you do defense and aerospace, that the analysts are all about PE. You'll realize when you do Carnival Cruise Lines that the analysts are all about EV to EBITDA. You'll realize that when you're doing social networking that they're all about EV to sales. Right? So basically different industries focus on different ratios. Right? Ratio number 6, price to book. Price to book is price per share divided by book value of equity per share. So it's if I gave you $1 of equity as a shareholder and you put on your balance sheet, what is the market value or what is the price of that share in the market today? So price to book above 1, creating value. Price to book below 1, destroying value. Price to book of 1, you just give me the money back. So price to book 1 means I gave you $1 and my dollar is worth $1. I'm no better or worse. So financially, what causes a price to book of 1? In theory. What businesses in theory should trade at a price to book of 1? By the way, this would be an example of the type of question you'll get on the midterm exam, Part B. Yes. I mean, that's potentially an answer, but I want to know financially. So as we think about like key value drivers or free cash flow or other things we've talked about, like what would cause the price to book to be 1 in theory? So I'll give you a hint. What would cause the economic profit or EVA to be 0? Because if the economic profit is 0, the company is exactly worth what it invested. That's saying it the same way. When does my economic profit equal 0? Well, I wouldn't use the not-for-profit here. These are for-profit firms. It's when the spread is 0. So that's the point. A price to book of 1, in theory, is indicative of 0 spread. A price to book above 1 means you've created value, means you've added something to it, positive expected spread. And a price to book below 1 is a negative expected spread. So price to book, just like PEG, is probably the cleanest ratio for inferring ROIC. Price to book is the cleanest ratio for inferring spread, expected spread of the industry. Here's the problem with price to book. It's the same as PEG. It can be distorted by accounting adjustments. Example, in 2008, when the stock market crashed, Lockheed Martin, which has a big amount of pension employees, had to take a big drop in their pension assets because the stock market went down. They invested a bunch of money in the stock market. It went down. Their pension assets fell like 30%. So here was what the accountants made them do. They made them write down all of the pension assets on their balance sheet, which means they had to take a big loss, and they wiped out a bunch of their equity. Then, since 2008, the stock market's recovered. Their pension assets have recovered dramatically. The accountants, the same accountants that made them write off all that equity when their pension assets fell, will not let them write up the value of the increase in pension assets. So Lockheed Martin, since 2008, has a lot of equity that was wiped out, and it hasn't been re-added, even though the pension assets are now worth about what they were 5 years ago. So when you look at the price to book ratio for Lockheed Martin, it is distorted because they have a high price relative to their equity, but that was because of an accounting adjustment. It wasn't because of the real value of the firm being what it was. And so I only say this because that's the one challenge with these ratios, is these ratios are impacted by accounting. And that's why the PE, the PEG, and the price to book ratios are more dangerous to analyze than the enterprise value ratios, because those 3 ratios are more susceptible to accounting adjustments. So I'm not saying that they're not valuable, because when they're clean, they give you really good insight. But often they're not clean. And when they're not clean, you can see confusing ratios where the PE will say one thing and the enterprise value will say another. And we'll have to take a step back and look across all the ratios to try and figure out what's really happening. Yes?
So based on that, why are banks mostly valuing price to book value?
Well, the difference with banks is under banking law, they can actually put the gains and the losses in mark-to-market accounting. So banks are allowed to do mark-to-market accounting, private companies are not. That's why. Although, interestingly, I was reading an article about banks, and banks are playing games with their mark-to-market accounting right now because of the regulatory rules. So, for example, right now, you guys took fixed income, or you took Sue White's class, you know about fixed income. What happens with long duration bonds when interest rates go up? Which is what's happening in the world today. Interest rates are rising. What happens to long duration bonds? What happens to the value? What happens to the price? They decrease, but they also go down much more. Long duration bonds. So here's the problem, is if I'm a bank and I bought a lot of treasuries, U.S. treasuries, at 1.7% that were 10 years or 2.5% for 30 years, and suddenly interest rates are a lot higher, I'm going to wipe out a bunch of my portfolio. So that's the problem with mark-to-market, is that arbitrarily when interest rates rise, it kills banks. So this is what the accountants did. They put in a loophole that says banks can list their holdings into what's called an AFS, available for sale account, or they can also put them in a held to maturity account. If the banks move them from available to sale to held to maturity, then they don't do mark-to-market accounting, and they can treat it as if they were held at par value to maturity. So this is the games that banks play. When interest rates were falling, they put everything into available for sale because they could write up huge gains on the prices increase of the bonds. They then took these same bonds as interest rates are rising, and they put them into held to maturity, and they said, no, 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 these same bonds that we just made all this money on, we're going to actually now hold them to maturity, so we're not going to take any losses as the interest rates rise, and we're not going to worry about that duration impact. So that's the problem with banks. Banks are really good at just getting around rules. That's another reason why we don't do bank valuation in this class, is because the regulators are not as smart as the bankers. And they set up these loopholes that the bankers just completely take advantage of. Anyways, so back to this. Those are the 6 key multiples. Hope I'm never in a regulated banking and market. Regulators will never like me. Anyways, I was thinking about which company we were going to do for our group project this semester, and I was actually considering Toyota, even though they're a Japanese company. Thought it might be interesting to do. So I'm not certain who we're going to do after the break, but we're going to pick a public company to all work on together as we build the valuation. So I was looking at their multiples, and this is an example of analysis you'll do near the end of the semester. In Bloomberg, I will show you after the midterm, Bloomberg actually calculates all 6 of those multiples for you. So you don't have to crunch the numbers yourself. What you can do is go into the RV screen, and just like you calculated the ROIC and the WACC, Bloomberg will calculate all 6 of those multiples. The other nice thing is because Bloomberg knows what the analyst estimates are, it actually calculates the forward multiples for you. So this is enterprise value to 2014 sales. This is enterprise value to 2015 sales. It's forward year 1, forward year 2 is the convention. So this is the average of these auto companies today. So basically the average for the auto industry, global, is EV to sales next year, 0.81. Toyota is trading at $1.25. So the average auto company, if they generate $1 of revenue, they're worth 81 cents. Toyota generates $1 of revenue, it's worth $1.25. That means Toyota is trading at a premium to the rest of the industry. So what did I say heavily influenced EV to sales? Profitability. So what does it suggest about Toyota's profitability? They're making better margins on their automobiles than most of the players in the industry. By the way, Toyota includes Lexus. Okay, so between their Lexus and Toyota brands, Toyota actually is not the cheapest, right? They actually mark their stuff up a little bit, and you're paying for that Toyota brand these days. And it shows up when they sell cars. They're getting more value for every sale than the average automaker. Next, enterprise value to EBITDA. What am I willing to pay for every $1 of cash profit? Because again, I'm going to have to take some of this cash profit and I'm going to have to reinvest it. Okay? And if I reinvest some of that cash profit, it's not going to be worth as much. So, enterprise value to EBITDA at Toyota is $9.05 based on next year's expected EBITDA. Average for the industry, $6.84. So I'm willing to pay a lot more for Toyota's profits than I am for the rest of the industry. Third, enterprise value to EBIT. Toyota, 12.14. Average of the industry, 9.78. So all three enterprise value ratios are basically telling me the same thing. Toyota's worth more than the rest of its peers. Okay? Now, let's continue. PE ratio is interesting. Toyota's PE is 9.05, industry average, based on next year, industry average 8.88. It's actually much closer in the PE ratio. So that does suggest that once you get past operating profits, those non-operating items, tax rates, etc., are probably causing them to actually lose some of that profit advantage. Right? Next, the PEG ratio. For $1 of earnings growth, the average auto company generates 67 cents of value. For $1 of earnings growth, Toyota generates 29 cents of value. Well, why do you think Toyota's trading at such a discount in the PEG? Assuming there's no problems with the PEG, what would that tell us? Yeah. Growth is not as valuable for Toyota as the average auto company. Even though their margins are better on the cars, the growth isn't as favorable. Why wouldn't the growth be as favorable? What do we say about the PEG? Yep. Yeah, the expected spread in ROIC is probably, particularly the ROIC is expected to be lower for Toyota, assuming the ratio is clean. Next ratio, average price to book in the industry is 1.6. Average price for Toyota, price to book is 1.3. Is Toyota spread positive or negative? Is it as positive as the rest of its peers? No. Here's the final number on there. Long-term growth rate, BEST stands for Bloomberg estimate, long-term growth rate in earnings per share. This is the 5-year growth in earnings, which directionally we'll use as a proxy for growth in cash flow, even though earnings and cash flow don't always grow at the same rate. So we're just looking at directionality here. The industry is expected to grow its earnings over the next 5 years at 16.29% a year. Toyota's growth rate is double the industry, 32.58% per year. So, if growth and return lead to multiples, why is Toyota's enterprise value multiple higher than its peers? Why is Toyota trading at a premium? Like I said, you could definitely expect a question like this on midterm Part B. In case you're wondering what midterm Part B is about, this is exactly what midterm Part B is going to be about. Stuff like this. I'm sorry? Well, they're more profitable, but we said growth and ROIC are the biggest determinants as a starting assumption for multiples. Toyota has a higher multiple. What about their growth rate? What can we say about Toyota's growth rate? It's double the industry growth. So, what can we say about their ROIC? Toyota has a above average, average, or below average ROIC? Below average. Why can we cite below average? 2 ways we can come to that conclusion. What? What's one? Well, one, it could be the growth is profitable, but there's 2 more compelling reasons that are right in front of us. Price to book ratio says that their spread is positive or negative. So it's not as positive. So they probably have a little bit lower ROIC. Is there another ratio that could help us infer the same thing? The PEG ratio. What's happening with the PEG ratio of Toyota? It's lower. The PEG of Toyota is lower than the industry. So because the PEG and the price to book are both lower, we can assume that Toyota is basically more valuable, not because they have a better ROIC. They probably have a little bit worse ROIC, but they're getting a lot more growth. So basically, I don't make as much per unit, but I'm selling a whole lot more units on a go-forward basis. My NPV is bigger. All right? That's what's happening with Toyota. I'm paying a premium for Toyota because of their growth. I'm not paying it because they have an expected return. What's interesting about this analysis is that ROIC is profitability, which the enterprise value to sales says is pretty good at Toyota, times what equals ROIC? Margin times what equals ROIC? Talked about this the first week of class, the second week of class. Margin times what equals ROIC? Productivity, cycle time. What can we infer about productivity at Toyota relative to its peers? It's worse. Because their EV to sales actually suggests they get better margins on their cars. Their ROIC looks worse because they have a lower PEG, a lower price to book, and that very high growth rate giving them better multiples. So they probably have a below average ROIC, but if they have high profits and below average ROIC, the only way you get to below average ROIC, you're not very productive. Now what's interesting, and that's why I was thinking about doing Toyota as a company, is when I looked at these multiples, that's not the bias. What you're taught in the academic world is Toyota is the most efficient automaker in the world. They basically practically invented efficiency. They've been doing Kaizen for years. Yet, when you actually look at their financials, their balance sheet does not look very productive at all. So it's really an interesting conundrum that this doesn't break out in the Bloomberg numbers, the operating from the non-operating efficiencies. And maybe they just got a lot of non-operating assets that aren't efficient. But nonetheless, the bias here is that the market is not valuing Toyota for its productivity. The market is valuing Toyota today based on much faster expected growth in the rest of the industry and a little bit better margins on their cars, not because they have a more efficient balance sheet. So that's something that we would actually want to test out and want to go deeper into the analysis, and I did. Toyota's Bloomberg ROIC is 3%. Their ROIC is terrible. It's actually a negative spread ROIC today. Obviously, it's expected to improve as the automobile industry improves with the global recovery, but I'm just saying the bias for Toyota, if I asked before I even started this analysis, would have probably been high ROIC. And right now, I don't think the market's really giving them credit for that. So that's what we see based on the valuation. So Toyota is trading at a premium, but the premium is because of their growth. Yeah.
What about for Mazda? Do they have a lot higher price to book ratio, but they have a lower pay?
So I actually was on Mazda when I took the screenshot, but Mazda has a really, really high growth and again, that low PEG. But here's the problem, is that price to book ratio is very high. And this is where one of those two numbers, PEG and price to book, is probably distorted. Another good example would be Mitsubishi. So that's the problem, is Mazda could have had some write-offs, and that could be distorting their price to book. Because if you actually look at Mazda's multiples, Mazda's trading at a discount to the industry. So with high growth and trading at a discount, it actually suggests a low ROIC, and therefore the low PEG explains that. So the price to book being much higher is inconsistent with the rest of the story. So that's why I'm saying ratio analysis means looking at the 6 ratios, taking a step back and seeing what they all tell you. And the price to book would actually lead you to the wrong conclusion in this example. So as I said, my sense is the accountants have been making some adjustments to Mazda's balance sheet, which is distorting their price to book. So that ratio is unclean and not giving me a true performance indicator of Mazda. Because I would expect that Mazda's performance is much worse given that high expected growth rate. So everybody see how I'm drawing those conclusions? You're welcome to go back and watch the video of this. So I'll be posting this video shortly on YouTube. All right, so this is going to end where we are for today. So again, coming up next week, you are going to be working on your midterm exams, part A and B. And again, I'm going to post this to